Hello, I'm Brian Overby, the author of The Options Playbook, and welcome to Options Guide TV. All right, so this week we usually try to come up with a strategy that we'd like to focus on for the week that's inside the Options Playbook. That strategy this week is going to be short spreads. We talked a lot about short spreads last week, and we're going to continue with that theme this week. The short spread that we looked at last week was a short spread in XOM, and we took two different approaches on that short spread. We looked at it as selling a short spread to try to buy an underlying stock at a lower price as opposed to a cash secured put. And then we also got a question about how to set up that short spread as a speculative play. Now, today we're going to go in and we're going to do like a short spread on steroids, if you will. We're going to use a short spread to try to generate some income so that we can get long out of the money call. And we're going to ride that theme off of a trade that we did a couple of weeks ago in the USO, and we had some success with that trade. We also talked about in that USO episode, I should say, how to roll that trade into a long call spread, because we were a little worried about how fast the underlying stock made a move to the upside. Wanted to sell a call to give ourselves some more upside, but take a little bit of risk off the table. And then to go along with this, we're actually going to have, I guess this would be deemed the retail earnings week, if you will. We have retail sales that's going to be coming out this week, but we also have Walmart, and I'll highlight them. I guess we could go to the Trade Hawk software right now, and I'll highlight that these are some of the stocks that we looked at. USO, these are some of the paper trades that we've looked at over the last few weeks. Now we're going to go in and we're going to look at Walmart's going to be announcing earnings. They're going to be announcing on Thursday. Target is Wednesday. And we start off with Home Depot on Tuesday, and TJX is actually going to be announcing this week too. So we're going to get a real good feel for the retail customer. And you feel confident in the way the markets have been recently, and the retail consumer has really been the I guess, driving factor that has kept the markets afloat. And I don't even know if a lot of the economists are using the word soft landing anymore. Recently, we had Goldman Sachs come out and say that there might be potential for a rate cut next year already. So they're already discussing that probability of that happening. Now, as far as the markets are concerned, the seasonality does concern me. We've had a real strong market, and we shared with you a VIX chart not that long ago about the seasonality of the VIX. It usually bottoms out in July, starts to rise in August, and then September and October are almost always the most volatile months of the calendar year. I don't know. You get into January and February, you do get some volatility in those months too. And so far, that has proven to be the case. Ever since September 1st, we had the downgrade of the U.S., the United States debt. And we've talked a little bit about that and just how silly that seemed to be to me that we would have our debt decreased, even though we do got to do something about it. I don't want to get into the political arena on that. But bottom line is that started the volatility in September. And the markets have had a tough time breaking out above the 4,500 range in the SPX. The one thing that does concern me the most about the markets is that we're seeing the 10-year yield actually increase. Now, we're getting good news from the consumer. Unemployment's still staying strong. Wages are high. The record agreement that UPS had with their employer and their union was crazy, just to show that wages are strong and the worker is strong at this point in time. But what I really like to see to go along with a lot of the good news, CPI is looking good. We had that come out last week. September, we got the Fed meeting with Jackson Hole that's going to be coming up, and they're going to be talking. So once again, the bond yields on the long end of the curve have been increasing. And the one thing that we would like to see is the bond yields come down on the longer term, on the 10-year, and the bond yields on the on the 2-year or the shorter term contracts also come down, but they come down at a faster rate than the long-term contracts. That was a mouthful, but if that would be a real, that would add a lot of fuel to the fire if we could start to see that happening. And the opposite is happening. The curve, the rate curve is actually coming in, the 10 versus the 2, which is a good thing for a lot of the financials, except for it's not happening the way that would really boost the economy and the financial stocks overall. So that's my outlook on the market. That's what we're kind of talking about. We're going to stick with this theme this week of selling put spreads, and we're going to use a put spread in an underlying like USO, which is tracking the price of oil. It's one of the, well, it's a very liquid underlying, and one of the ways without a futures account that you can actually trade oil and the breakout that we've seen in oil. I think it's official that we can say that it is an actual breakout. So let's first of all start by looking at that chart. Well, actually, let's start. I'm getting a little bit ahead of myself. Let's start by looking at the XOM trade. So XOM right now is at 111.11, $111.11, and that's it's down a little bit today. It's down about 77 cents. So we positioned ourselves last week by looking at, let's sell a put closer to the strike that would allow us to buy some shares of XOM. But we're still talking about the energy market. You still have some scary things out there, especially geopolitical issues that can happen. And so let's buy some protection. We wouldn't mind buying the stock if it came down, but we're going to buy some protection to try to offset some of that risk. So that trade, we looked at the September 9th or September 8th date, which is 25 days away. We sold the 109. That was the income that we were bringing in. And the stock was about 111.70, somewhere in that range. It's down 76 cents today. We were dealing with live markets here. And as always on Options Guy TV, we're just trying to learn. And we give you usually a couple of strategies because we want to be able to compare what's the thinking of selling the 109 strike as opposed to going out a standard deviation and selling the 106 strike. So that's what Options Guy TV is all about. And as always, if you have any questions or comments on the show, please put them in the comment box and we'll try to address them at the end of the show or sometimes during the show. So just keep that in mind that we want this show to be as interactive as possible. Okay, so the 109 strike is what we sold, and the 10 and we bought the 104. Okay, so here's the theme here. We were looking to buy the stock. So we're selling the 109, buying the 104. We're going 5 points wide. We don't want to spend too much of our credit for the protection because we don't mind owning the stock. We just don't want the stock to fall out, the bottom to fall out before we purchase it. So we bought it, spent a little bit of our credit, which was a decent credit because we sold something close to where the stock is at, and spend a little bit of that to buy some protection. Now, the stock has came down. So are we upset about this? Is this a good thing or a bad thing if we did this trade on Friday and stocks came off a little bit? Ideally, it's a good thing, right? And this is one of the hard things about option trading. A lot of people will say when you're trading options, everybody that buys option contracts, the calls expire worthless or the puts expire worthless 80% of the time, and you lose money on options. And that's just such a tough statement in the options trading world. First of all, completely wrong about how often option contracts expire worthless. It's very rare, actually. About 30% of the time is when options actually expire worthless. And that's mainly because people get traded out of. And these numbers are by the Options Clearing Corporation. They post them every year. How many options actually get closed on the marketplace, how many options expire worthless, and how many options actually get exercised, i.e. assigned on the seller side of things. So we're 5 points wide. This is actually pretty good for us. This is what we were hoping to happen, and we'd love it to come down and work its way by the September 8th expiration down to the 109 range. It would be great if it was like at 108. We put the stock, we buy the stock, and we bought in, and we brought in, when we did it, we brought in $1.13 credit to the account. So we can use that to actually buy that underlying stock. So I don't mind if it's somewhere between 109 and 108 and we put that stock. That's what our goal was when we put this all together. All right. Other one that we looked at, we went and had a question about how could we do this as a truly bullish trade, bullish to neutral, if you will, if the stock just stays where it's at. How would you then set up that trade? Well, that trade doesn't look bad either. We went in, and I'll clear out this first trade that we put on, and we sold the 106 call. So now we went a little further out, and we tightened in our spread. We did a little bit more for speculation. Now, we are always looking at these on a one-by-one basis just to keep things simple. You trade whatever lot you're comfortable with, or your speculative money would be afford you to do in your account. So we're going to sell that one at 106. We're going to buy this at the 103. So now we're going 3 points wide, same expiration, but we're getting closer to where that one standard deviation move is. So in other words, we really want this one to expire worthless. We put that on for 50 cents, and now it's trading for 48 cents. So even though the market's down a little bit, implied volatilities must have came off a little, and we're actually making 2 cents on this trade. Not that big of a deal. But ideally, you would think, though, that this might be trading for 55 or 60 cents. So this says to me that something has changed in the marketplace on this expiration. It was the September, right? And something has changed and has affected the options price above and beyond the actual movement of the underlying stock. All right. So that sums up XOM. We'll come back and we'll look at it. We got some time for this trade. We'll keep an eye on ExxonMobil and the stock price and see if the stock does come down and we get that opportunity to buy it at that lower price over time. All right. So here's the short put spread on steroids, if you will. We're going to look at, we had a strong trade in USO. And if I go back and look at the chart of USO, it was right here on this breakout. Okay, so this is a USO chart, 800 days. We got the 200-day moving average in here. We got a 20-day moving average, and we got a 50-day moving average. We had this golden cross, and it looks like we're going to kind of, right now, we're kind of developing a real, well, I consider a golden cross to be more exciting when you have larger moving averages involved. So right here is a 50-day moving average, and here's a 20-day moving average. It's crossing, it's breaking up, it's putting our ducks in a row, right? So then you'll have the 50 below the 20, above the 200, and that's usually a sign of a good bullish market. So that's what you'd like to see. It's just one data point, and I mentioned it before, but when we got that breakout here, got a strong breakout to the upside, we looked at buying the USO as a long call, out of the money long call, right around 68, got up to about 72, and then we thought, well, we got a good solid move to the upside. We broke through our strike. Let's now sell a call against it and give ourselves some more upside, but bring in some premium and take some cash off the table. Strong trade on paper, as usual. And now we're going to feed off of that, because part of the reason why we sold that call is we got a little nervous right up here. When we got this little breakout here, we were hanging right around this area, and it continued on up, which doesn't hurt our position whatsoever. And now it's backed off a little bit. So Still like the way oil is trading. I still like even the way the futures contract looks like. So how can we repurpose this trade? And as always on Options Guy TV, realize that we're just trying to find underlyings that we can apply a lot of the trades to. There's no golden book of answers as to what trade we would like to use every week and week out, right? There are a lot of strategies where people just want to do an iron condor in the SPX every week or every month or every quarter. And there's nothing wrong with that. That just kind of makes boring TV, though. But so we're trying to find underlyings and try to talk about specific strategies and when they might apply. Because to me, the underlying determines the strategy I'm going to do. I don't start with a strategy and then say, this is the strategy. I don't care about what underlying I'm trading. I'm always going to use this strategy. All right. So we got a little bit of a sell-off. We still got some volatility that's in the marketplace as far as USO is concerned. We're going to sell a put spread to buy a long call. And I'm going to try to get this done for very inexpensive debit to the account. I would like to do it for even. But from what I looked at on the trade while I was getting set up for the call, I don't think I can pull that off. I think I'm going to pay a small debit to do this trade. And like I said, this is short put spreads on steroids. The strategy would be. I actually don't name the strategy inside the options playbook. We look at selling put spreads and we look at buying calls, but I actually haven't combined that in the 40 different plays that we have in the playbook. So this is a new territory, if you will. But I think this is an interesting underlying to maybe do this on. All right, so let's look at it. All right, so we're going to go out to the September. I'm going to remove our XOM trade. We're going to go out to the September 18th expiration. That's September 1st expiration, 18 days out. It makes me nervous, honestly, that it expires in September, but I'm pretty sure we'll probably be out of that trade. And that's all it is the volatility of September. There's no rationale behind it, but September, just like August 1st, we had a pretty big downturn. September 1st always makes me a little bit nervous on that day. And if I look at this on the USO, we're going to use this expiration. So we need to sell something. And I actually don't really mind if I bought 100 shares of the USO. That's kind of my thought in this. But we're going to sell something closer to the money because of the strategy. Not that we don't want that short put spread that we're going to sell to expire worthless. I just want to bring in some decent cash. And I want to keep in mind that I still can trade out of this. And yeah, I really personally wouldn't mind if I bought a few shares of the USO. So I could decide either way with that trade as that trade is living. So if let me look at the what if strategy. Here's what we had. We're going to sell the 72, buy the 70. That we're going to look at that graph here in just a second. So I want to make sure I was using the right strikes. So we're going to be selling the 72, which is now trading for 94 cents. And we're going to buy the 70, which is now trading for 50 cents. Okay. I'm selling the 72 and I'm buying the 70 as protection, much the same way that we set up the XOM trade. And when we're doing that, we're going to bring in a 50-cent net credit to the account. Now, I like that. And that's, I'm going to try to take that 50 cents and let's go spend it. Let's go on a spending spree. And let's use the same expiration and let's buy an out of the money call. Only difference from the first trade that we did in the USO a few weeks back is that we just bought the underlying call outright. We have decent markets in the USO. They're fairly tight, fairly good liquidity. So where can we spend 50 cents? If we look at this expiration once again, and we look at when we get out of the money, what's selling for 50 cents? Well, we could do the 77 strike and we could do the 78 strike. 78 strike would allow us to do this for a net credit to the account. And it's tempting, but I want to give myself a little bit more upside. So the 78 strike right now, if I look at the delta, that's a 17% chance of that underlying reaching that by just looking at the general definition of delta. I don't mind that. I actually don't mind that. The market moved a little bit on me, but I think I'm going to do the 77. If we look at the most at the money strike here right now at 74, we're talking about 180 and 180. So you're talking about 260 here, or 360, I should say. So if I'm doing this trade, I want to make sure that the underlying stock can get there. So I want to look at the math and say 360 plus 74 gets me, that's the expected move, gets me above 77. So I'm going to do the 77 here. Let's buy it. So I'm going to click on the ask. And now we're doing this for a net debit of 20 cents. We have additional risk. We have the risk of the short put spread, which is 2 points wide. Still not a ton of risk. On a 1 by 1 by 1 basis, we're still looking at an outlay of cash of $200 on the downside if the market came down all the way down to the 70 strike and expired below that. And we have a net debit of 17 cents. Well, 30 cents. We'll call it 20 cents. Make the math simple. And that'll be the official paper trade. We'll call it, I think we could fill that at 20. And I always guarantee that if there's no guarantee that you're going to fill at a midpoint, just keep it real, right? There's no guarantee that you're going to sell that. So then we got to add that net debit into the account of 20 cents. So our total risk is going to be $2.20 on this trade. One thing that's wonderful about the trade is that we're very neutral as far as time premium is concerned. I'm not in a hurry. If a week goes by and the stock is still at 74, I'm okay with that. Why? Well, I have an out of money option contract that's getting hurt by time decay, but I have a sold a short put spread that's getting helped by time decay. So we're offsetting that risk to time value. And if the stock stays within the range, and this is where I'll go to the what if on the TradeHawk software, this really highlights the strategy behind this graph, where you see that between the strikes, we're just fine. We can lose 20 cents on the trade if it doesn't go anywhere whatsoever. But on the upside, we have unlimited upside because we're long a call option. On the downside, we have downside risk, but it's stopped at 70. From 70 on down, I can't lose any more on that trade. So just an interesting way, an interesting alternative to what we talked about by just buying a long call option. We'll sell this short put spread to afford to be able to buy that long call option on this trade. I still can manage this risk, but this is a little bit of a trade that, well, you know, the one thing that I will do on a trade like this is if I did get a fairly big upside, I might sell the long call and then eventually close out the short put. So it is a trade that I would leg out of if I'm looking to do this, especially if I could double on that long call on the upside. We need a good move to the upside for that to happen. It's still a shorter term trade, 18 days. But it is a trade, the way that we have it set up, if you're willing to buy the USO down around that 72 level, well, this is kind of a trade that you can just let ride. You know, you want to take your profits when the profits are there. But as far as the risk of the trade, we put it on. Time decay is not a big deal. We got 20 cents of total risk if the market stays within our strike prices. And if not, we know the risk on the downside. So that's a very simple trade that we don't necessarily have to have a plan exactly when we're going to get out if we're willing to buy 100 shares of that stock. All right, I see that we actually have a question here. It's good timing. I'll leave up the what if calculator in case we need it. How would you calculate? So the question comes in, how would you calculate the return on investment on this trade? Would you do it using the margin needed for the spread, or would you calculate the overall return on the monthly ROI? All right. So if I'm looking at the return on investment, I got to look at what my investment is, right? And we mentioned right now, you got a cash outlay of 20 cents to execute the trade, net debit to the account. And then you have a short put spread that has 2 points of margin. On a 1-by-1 basis, you take the 2 times 100 and you get your total risk on the downside or your margin requirement of $200. So if I'm looking at this trade, if I'm putting up $200, that's going to be my cost basis on the trade. That's going to be the amount of premium that I have to put up to and use to calculate my return on investment. It's not the 20 cents. It's not just putting in that net debit to the account. I need to look at the capital that I put in. So if I want to double on this trade, I have $2.20 worth of capital. I would want that to go to $4.40 in order for me to make a double on this trade. So very solid question. I appreciate it. If you have any other questions, please put them in the comment section, and I'm happy to address them at any point in time. All right. So this is going to be our official paper trade for the week, and I'm going to emphasize what we're doing, and I'm highlighting it on the options guy. On the options grid. USO is at 73.87. It's down 38 cents on the day. We're going to go out to the September 1st expiration. Our risk is coming from selling the 72 strike put. Our our protection is coming from buying the 70 strike put, and then we're also going to go in and sell and buy the 77 strike put. And we're going to do this all for a net debit to the account of 20 cents. So it's a 1-by-1, no ratio involved here. Selling a put spread to buy a long call. No specific name for the strategy, but I guess we could say short put spread on steroids. I mean, I think it gets a little bit overused, but that's what we've turned the short put spread into, is a very bullish trade, or we want a big move to the upside, as opposed to just sitting there and just hanging out. All right. Any other questions? All right. We do have another question. How does the spread have? Does the spread have a fancy bit, a fancy bird name? And the comment is, I heard it as a seagull. I don't mind that. I like the seagull. Maybe we should name that like we did the fig leaf. So I do not mind the seagull. It's a lot easier to say than a short put spread on steroids, but maybe the next book will have to come up with a new name for this strategy. And definitely, I like this strategy. I really do. So if I did write another book, I would actually add this strategy to one of the strategies that's around. I think more people do it than you know. And this is, once again, an underlying where I would consider to do that strategy on. The reason why we like, well, let me run to that then. Okay, so we're going to look at this as a seagull. If we look at the what if strategy, it looks like a seagull kind of coming in for a landing. Maybe we call it the soft landing. This is maybe the soft landing that all the economists are talking about. I don't know, because it kind of looks to me like a plane trying to land on a windy landing strip. Hence the economy and the soft landing. No, all right. I think seagull is better, and I'll stick with that. All right. Well, thank you. We're at time, exactly at time. So thank you for coming to Options Guy TV. Please click subscribe, ring the bell so you get all the alerts, and pound that thumbs up. Options Guy TV, we're just taking off here, and we're very excited that you're spending some time with us today. So we'll see you this Wednesday at 11 a.m. for the next edition of Options Guy TV. Thanks for coming, everyone.